Welcome, I'm Catherine Magana here with Rachel Ivanovich, Vince Stefano, and Greg Carroll, where we're here to provide you insights on the markets, planning, taxes, and much more. Today is April 16th, and the big headline news this morning is Israel and Lebanon have reached a 10-day ceasefire agreement. So that's obviously positive for the market. Here we are the day after tax deadline, so Rachel's here with us today. And then we also have Vince is returning this week from being at a wedding with his family. So congratulations to your son.
Looking very tan there, Vince.
Right. I say one down, one to go. But it's good to be back. So we do have some positive news to share. So as of yesterday, which was April 15th, the markets, we are in positive territory, which is great news. The Dow Jones as of yesterday was up 0.83%. But over from, it's kind of awesome. Well, let me go over where we're at year to date. And then the NASDAQ is up 3.33%, and S&P 500 2.59%, and the Russell 2000 9.34%. So we've had some pretty decent returns. But it was interesting. Yesterday, I was talking with a client and going over their portfolio and the returns and doing a portfolio review and financial planning review. And one of the things that came up was they were looking at their March statements, and so
good timing.
Like, yes, and so I was like, they're like, I'm down. You know, a lot of things were down at that time period. So I thought it was interesting. A couple weeks later, how much everything had shifted, and so I thought I'd share with you a little bit about where we were when we did our podcast. And this was back at our April 2nd podcast, and so I was looking at where we were at with the markets, and that would have been as of April 1st. But since then, the Dow Jones is up over 4%. And the NASDAQ is up over 9%. The S&P 500 up over 6.5% since then, and the Russell 2000 over 8%. So a lot has changed in a short period of time. Obviously, we're not jumping in and out of the market. We're not market timers, but it is nice to see us back in the green. It's been quite a year so far.
I think I heard this morning if the NASDAQ's positive today, it's the longest streak since like the .com bust.
Oh, yeah. No, it's
long time.
Yeah, it's done very well. Like I said,
I think you have that correct. Yeah. I think it might be 12, 13 days of straight NASDAQ upside.
Yes.
So looking at where we're at with interest rates, so looking at the 1-year rate, the 1-year CD is at 3.95, and the 1-year Treasury is 3.75. So this 1-year CD is up slightly from last week, not a big change. Looking at the probability of a rate change, there's pretty much no change that's going to happen at the next meeting. However, looking at the probability of a rate cut this year, which has been changing a little bit. It looks like right now we're at about 35% chance there will be one rate cut this year, but anything can happen between now and the end of the year, and that keeps changing, obviously, as well. Looking at the mortgage rates, so as of yesterday, the 30-year was at 6.38, and the 15-year was at 5.78%. So we have seen it tick down just slightly over the last week, but not too much change. And then the CPI numbers for as of March of 2026, it came in at 3.3%, which is higher than February, which came in at 2.4%. So obviously, what I think we're feeling it more. I know it's not priced in, but obviously the gas prices and everything else that things cost, I think we're feeling it a lot higher than that. So that just kind of gives you an update of a couple things that are kind of taking place. Do you want to share a little bit more?
It's interesting. I was listening to Treasury Secretary Bessent. He was giving a White House briefing yesterday, and he made some really interesting points. The first one was he said that he felt that core inflation was coming down, and he felt that as the Iran war, conflict, whatever you want to call it, begins to subside, he said gas prices should be coming down very dramatically very soon, and he thinks there'll be a 3 handle back on the average price of gas. Not here in California, but in other parts of the country,
Never
of
again.
course.
I said, not here. We have a.
He also said that he felt that there's been a sizable uptick in construction jobs, and he said that's going to lead to better manufacturing jobs in the future. So that's real positive for the overall economy. He also said, and we've said this all along, the market itself, it lives in the future. So it keeps looking 6 to 9 months ahead and forecasts what's the world going to look like. And I think the market's thinking that, hey, we're going to get a peace proposal. We're going to get some, an end to this conflict. We're going to see rates come down. We're going to see inflation trend down. And the economy is going to remain very, very solid. So I thought that was really interesting. He also said that 5 million of those, quote, Trump accounts have been opened, and 1.2 million people have taken advantage of the $1,000 seed money. So again, very positive for the overall market itself. And I think, and I'm going to step out of my kind of line a little bit here, but I'm going to say, he said something about tax refunds were very substantial this year, and he was saying that the average person is going to see over $3,500 of tax refund. Now I don't know. That's
not my clients.
Well, you have. Well, this is the Treasury
Are
segment.
they more?
Yeah. They make so much money. They just got blasted this year.
Yeah, I think he's just looking at kind of like the overall lower middle class.
If you really look at the changes of the One Big Beautiful Bill Act, a lot of the no tax on tips and so on and so forth, that really it was phased out for higher income earners, and therefore a lot of my clients who make upwards of $200,000, $300,000, $400,000 annually, those deductions don't apply. And so, amazing, we have a deficit, the amount of money these poor people had to pay.
Yeah,
this
but
season.
again, I think he was just making a point that where the middle class tax cut came in, and that's what they were.
So I
people
agree.
that aren't paying estimated taxes and so forth, right?
I disagree. So for instance, this was one of my surprise moments during tax season. So I have a client, it's a couple, and what her comment when I finished her return is, in all of my years of being in business, I have never gotten such a big refund.
Oh.
Wow.
So what had happened was, she is a hairstylist, and their joint income was, a little under, let's just call it under 200,000. But because she's self-employed and she uses Square, the Square report showed her tips broken out on the Square report. So she had $23,000 worth of tip income, which even though it was subject to income tax for self-employment, it was actually a tax deduction. So she ended up getting $7,000 back with a refund.
Okay. Pretty good.
And so she was so excited. And for me, it was I almost missed it, to be perfectly honest. But then I was looking at the Square report again right before I sent the return over, and I said, wait a minute, I think this is a tax write-off. So that's the fun moments with the tax code when you have new tax laws. You really need to be, searching for those opportunities, and they don't apply to all of your clients.
Anyway, that was just one of those things that I heard from
So she truly did. So she got a bunch of money and was very excited about it.
That's terrific.
So on the tax note, it was interesting over the last several months, Carrie and Kristen have helped a lot of our clients get the 1099s and year-end summaries, 1099-Rs, the K-1s, which for those of you that are in alternative investments, those typically don't come out till the end of March. And so I know there's a lot of clients that are anxious to get that, but unfortunately some of those don't come out till later in the season. And so we now on the other side of it, it's nice to know that there's the first deadline, but I know there's additional deadlines for other.
And my advice for clients who do receive Schedule K-1s is get your CPA everything except for the K-1, and just let them know I'm going to be missing one or two. Because otherwise, it's easy for the tax advisor to say, you know what, I'm just going to put you on extension. If you're sitting and waiting, or if you get all your tax documents in, let's just say you wait until you get everything and then hand it off, April 1st, and then the joke's on you because you're getting extended. But I definitely feel that it's a better practice to get everything in, and then get filed by the tax.
I can't remember the last time we filed by April 15th.
Me neither.
Yeah.
And then
You're busy doing everybody else's
And then
stuff.
another thing we saw recently, which doesn't happen very often, but I thought I'd share this today, is so we had a client that they added money to a Roth IRA. They actually made electronic deposit in. And so they came back and said, I don't qualify for the Roth, and so
that all the
that
time.
was yes. And so the workaround with that was we were able to recharacterize that deposit or contribution into an IRA. But it even gets more technical because the only reason we were able to do that is because they did not have a 401k and they did not fund their IRA. So they were able to recharacterize it, and they needed to take that deduction on when they did their taxes. So behind the scenes, there's a little bit of maneuvering, and sometimes what we find is, I think some clients think, oh, I can do this. I want to fund a Roth, and then but we have to kind of unwind certain things occasionally, or there's excess contributions that are made that we have to revisit. So it's just some things that we look at and work out. So if you're going to make it to contribution, maybe notify us or notify your CPA so that we're all in agreement before you do it.
My advice on that is, especially with a Roth, is you may want to wait because you have until April 15th to make that contribution of the next year. So, for instance, you could have made a Roth contribution for 25 up until yesterday. So maybe you wait until you kind of see where your income lands before you make that contribution, because otherwise you have to jump through the hoops to pull that money out before the deadline.
Yeah, so just the behind the scenes that we see.
Well, now that
Well, I was just going to say, we haven't heard the Fear and Greed Index in a while, so
yes.
we missed it last week.
We did. So I'll share, we didn't share it last week, but last week when we got together, which was on April 9th, the Fear and Greed Index was at 36. And so now, as of this morning, April 16th, we're at greed at 63. So a pretty big jump in a week.
And 2 weeks ago, the end of March, wasn't it like in the
13?
teens? 13, 15,
it went-
16? Yeah.
And
now it's in the 60s.
Because tax season's over.
Well, it's not only the tax season, but it's amazing what a little market rally can do for the Fear and Greed Index. And if you kind of look at the market over the last 3 to 6 months, people got very, very bearish, especially when the war came on. Most investors, believe it or not, still feel the market's a little undervalued, which is okay. I was reading something in the Wall Street Journal. Most hedge funds are still super short, which can lead to a big upside because as the market rallies, these shorts they have to cover.
Meaning buy back all
they
the
have to
stuff
buy back
short,
all the
so
stocks.
it's creating even more demand.
Right. And J.P. Morgan, I was listening to Jamie Dimon. He said that he is expecting a sharp V rally, which,
Jamie Dimon.
Jamie Dimon
Wow.
said that, which was kind of interesting.
Yeah.
And if you look even further into that, the Mag 7 stocks, and we talk about those a lot, they've been out of favor really for the last 6 months?
Yeah.
Well, guess what? They're coming back into favor. And they're coming back into favor because we've talked about this for a while. The big issue was CapEx, how much they were spending, whether they were going to monetize that CapEx on their AI investments. Well, now it's kind of interesting because the analysts in Wall Street are now saying that these Mag 7 companies are leading in innovation. And we've been talking about innovation now for the last couple of months, saying it's going to change from CapEx to monetization to innovation, and it's continuing down that line. And I think we're seeing that, and that's why the NASDAQ and some of these stocks have rallied so dramatically. So, new highs, we're hitting new highs, but that doesn't mean it's bearish. That's not a bearish call. Streaking indices don't mean it's over. And I was reading, and I mentioned to Catherine yesterday, and a client that when a client was in, I read something from an analyst that I've followed for a while, and he's a very good software analyst. Software has been killed over the last
I was going to say, under
3
Mag
months.
7, there's been a couple in there that
There's
got
been
hit.
some software stocks that are down 30, 40, 50% from their highs. But what's kind of interesting is there was a big concern that AI was going to replace a lot of the software stocks.
Right.
Well, no, that's not happening. What they're finding now is that most of the big software companies are taking their innovation, their R&D, and they're moving into all of these new AI capabilities and putting their new AI capabilities into their platform to sell to their existing client base. So what we're going to see, and what I'm hearing in reading from some of these software analysts, is that this might be the most ultimate contrarian trade we're going to see in a long time, and that's in software stock. So again, markets swing very quickly, rotation happens very quickly. So, be positive, and I think you have to continue to stay in very, very good, innovative companies.
I think along that software, that AI was going to basically eliminate a lot of the software companies. Well, it came out this week too that OpenAI and Anthropic, the two big disruptors, actually use some of these software companies that are down 30, 40% in their own businesses.
And what you were saying something yesterday, I don't do structured notes, but you were saying something about a structured note on software company. What were you saying?
Well, yeah, in a structured note, you have underlying indexes that basically drive the return of the note over a period of time. And the more volatile, and there's interest rate, equations in there too, but the software index had been beaten up so much and so volatile that we could have gotten a very, very high rate of return.
A week later, say here, I think
Yeah.
it's a game changer because now that's up a lot. now.
Exactly. So, it might have been a little risky for the notes that we do because the income notes, we want to make sure they're very, very conservative in the sense that nobody should lose any money. They're going to get their income over the period of time. But you can put together growth notes that don't pay income and use notes like that and potentially do very well. So it was a little more aggressive, but we decided
I was
against it.
just kind of interested when you mentioned that software structured note to me, and it was at the same day when I was reading that this could be a very ultimate contrarian investment. So again, I've always liked software stocks. They have incredibly high margins, and you just have to move through cycles. And the cycle got a little bearish, but I think it's going to turn. And when it turns, we see things turn very, very quickly.
Yeah, those big companies aren't going to sit around and watch things pass them by. They're going to innovate, and they're going to be very relevant for a long time. So,
and then we're starting to see the expected earnings are starting to come out next week. So there's going to be a lot of things to report and see how those.
Yeah, we did see some of the big banks come out, and they came out very solid. And what was kind of interesting is a lot of the Wall Street banks, what drove their earnings were trading revenue. So obviously, when the markets get very volatile, you see a lot of trading both on the buy and the sell side. And I'm going to end with one more thing. This is kind of interesting. I read this again in the Wall Street Journal. The average cost of raising a child to 18 years old is $300,000. And that's only till he's 18.
And then there's college.
And then there's college on top of that.
And then they come back home.
It's another 300,000.
I just saw that. I said 300,000. That's a bargain compared to what I spent on my kids.
You didn't add in the weddings and everything else.
Cars, insurance, all that other stuff.
Man.
Yeah.
So here we are the day after tax day, and Rachel's here with us, and I think she's ready to call it a day. She needs a day to recover.
Yes, or a week or two. But I just want to touch on a few tax surprises and/or planning options for the next, let's just say until December. I believe this is a prime opportunity if it's right for you. Of course, it's not a one-size-fits-all, but Roth conversions might be something to consider this year, strictly because there are some additional deductions that were surprises for me for some clients and not surprises for other clients. But for instance, the state and local tax deduction, that's only going to be in place for the next through 2029, unless they make it permanent. So what that basically is if you itemize your deduction, you can deduct your state and local taxes up to $40,000, depending on what your income is. So this would definitely, and there was a cap of $10,000. So you have that additional bracket, let's just call it the deductions that you can look at. Is this the time to maybe convert 10,000, maybe 20,000, 30,000, depending on what your income is. The other deduction that is out there is the senior deduction that I saw some clients, and that's $6,000 if you're over age 65, and if your income's under a certain dollar amount, you can take advantage of this as well. And so it might also present the time where you can do a conversion if it's right for you. But that is also phasing out at the end of 2028, so also only available for a few years. So I think it really presents some planning opportunities.
So kind of going back to the Roth conversions, we get asked this a lot, and we look at this very closely. And so between now and the end of the year, looking at your income and seeing does it make sense to do a partial conversion or not. And there's some other things we've shared in the past to consider. So if you are interested in having us take a look at this for you, we're happy to do those projections and see if it makes sense. Because when you read articles and you see a lot of information out there, everyone do it. But the reality
is it might not make sense for you.
Exactly.
Yeah. But I do think it might be a good planning opportunity.
Absolutely.
So ask the question.
So I think we covered a lot of ground today. So, and we obviously we're on a positive note, which is great, and hopefully we'll stay that way. And so we want to thank you for joining us today. And until next time, thank you.
Happy investing.
Happy investing.
Yes.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.